Welcome to one and all. Today I am going to take income tax law and practice for third BCom, shift 1 and shift 2. So first we will see the basic concept of income tax. First we will see meaning of income tax. Income tax refers to annual taxes levied by the federal government and most state government on businesses and individuals must file federal and state income tax returns every year, individual and business income. By law, to determine whether they owe taxes, government use the tax they collect to fund their activities. Then we see the concept of income. In common parlance, income is known as a regular periodic return to a person from his activities. However, the income is broader classified in income tax law. The Income Tax Act even take consideration of income which has not arisen regularly and periodically. Then we'll go for the previous year meaning. Previous year is a period in respect of which a person has to pay tax. In Income Tax Act, the previous year is a period of 12 months beginning from April 1st to March 31st. Assessment year. What is assessment year? Assessment year may be defined as a year in which the income tax of the previous year is to be assessed. It is a period of 12 months starting from 1st April of every year and ending on 31st March of the next year. Then we will go for the meaning of person. As per section 2, subsection 31 of the Income Tax Act 1961, unless the context otherwise requires, the term person include, he may be an individual, he may be an Hindu undivided family, it may be a company, a firm, an association of person or a body of individual, whether incorporated or not, a local authority, and every artificial judicial person not falling within any of the preceding subclasses. Then we will define the person. The term person is defined under the Income Tax Act, covers in ambient, natural as well as artificial person. For the purpose of charging income tax, the term person under section 2 subsection 31 of the income tax includes individuals, Hindu undivided family, association of person, body of individual, firms, companies, local authority and any artificial judicial person. Then we go for the meaning of assessee. An assessee is any individual who is liable to pay tax to the government against any kind of income earned or any losses incurred by him for a particular assessment year. Each and every person who has been taxed in the previous year for income earned by him is treated as assessee. Then we see the various types of assessee. Normal assessee, representative assessee, deemed assessee, assessee in default. First we will see the normal assessee. An individual who is liable to pay tax for the income earned during a financial year is known as normal assessee. Every individual who has earned any income earned or losses incurred during the previous financial year are liable to pay tax to the government in the current financial year. Next we will go for the representative assessee. There may be a case in which a person is liable to pay tax for the income or losses incurred by a third party. Such a person is known as representative assessee. Representative comes into the picture when the person liable for tax is a non-resident, minor or lunatic. Such people will not be able to file tax by themselves. The people representing them can either be an agent or guardian. Then third one, deemed assessee. An individual might be assigned the responsibility of paying tax by the legal authorities and such individuals are called deemed assessee. Deemed assessee can be the eldest son or a legal heir of a deceased person who has expired without writing a will, the executor or a legal heir of the property of a deceased person who has passed in his property to the executor in writing, the guardian of a lunatic, an idiot or a minor, the agent of a non-resident Indian receiving income from India. Then fourth one, assessee in default. Assessee in default is a person who has failed to fulfill his statutory obligation as per the Income Tax Act, such as not paid tax to the government or not filed his income tax return. Then we go for the meaning of income. Income is money or some equivalent value that an individual or business receives in exchange for providing a goods or services or through investing capital. Income is used to fund day-to-day expenditure. For individuals, income is most often received in the form of wages or salary. We will see the various types of income: active income, passive income and portfolio income. Under the active income, income for which service have been performed. This include wages, tips, salaries, commissions, and income from business in which they are is material participation. Next we will see the passive income. Most types of passive income are derived from real estate or property, while other type of passive income are derived from royalties, from patents or license agreement. An income stream falling into this category is one where money is received usually on a regular basis, where no additional effort has taken place. Most passive income streams require great effort to start with. Next we'll go for the portfolio income. Portfolio income is income from investment including dividend, interest, royalties and capital gain. I would say that portfolio income is a subset of passive income. Then we go for the meaning of gross total income. Gross income refers to the total income earned by an individual on a paycheck before tax and other deduction. It comprises all income received by an individual from all sources including wages, rental income, interest, income and dividend. Then what are the steps to be calculated for gross total income? First step, identification of residential status. A person's residential status plays a key role in ascertaining the income which should be included in the taxable income of the person. Income classification. As per the Income Tax Act, the income is categorized under 5 heads of income, which covers all types of sources through which one can receive income. These are salary. As the name suggests, it takes into account all the receipts and perquisites from the employer, including pension. Then second one, income from house property. It covers rental income. Then third one, profit and gains from business or profession. It includes profit generated from the running the business or receipt from the profession. Then fourth one, capital gain. Profit on the transfer of movable and immovable property. Then the last one, income from other sources. All the income which are not covered under the above heads are taken to this category, such as interest income, royalty, winning from lottery or toss by persons, etc. Then, calculation of income under each head. Income should be calculated as per the rules of the specific head of income under which the source is covered. There are some specific income which are completely exempted from the tax, and such incomes are not added up in the gross total income, like income from agriculture. Then, clubbing up income. To prevent avoidance of tax, rules related to clubbing up income is applied in which income earned by the spouse or minor child is included in the income of the assessee. Then, set up or carry forward and set off losses. There may be various income sources under the same head, wherein the assessee may be receiving profit from one source and incurring a loss from the other. And so, the loss from one business is set off against the profit from the other source under the same head. Then, calculation of gross total income. At the end of the process, the final figures of income or loss under each head is computed after making deductions and other important adjustments and providing for clubbing of income and set up and carry forward of losses. This will be the format for gross total income. Income from salary. Under the heading income from salary, we have the salary, bonus, commission, etc. Then taxable allowances, value of taxable perquisites. We'll get the gross salary. Then we go for the deduction under section 16. Then we get the net taxable income from salary. Then income from house property. Under the income from house property, we have the net annual value of house property less deduction under section 24. That will give the income from house property. Then profit and gains of business or profession. Net profit as per profit and loss account, less or add. Adjustment required to be made to the profit as per provision of Income Tax Act. You will get the net profit and gain of business or profession. Then next we will go for the capital gain. Capital gain as computed will be exempted under section 54, 54B, 54D, etc. You get the income from capital gain. Then the next one, income from other sources. Gross income less deduction, you will get the net income from other sources. Just in grossing up all the income from a salary, house property, business or profession, capital gain and income from houses, you get the gross total income. Then go for the reductions available under section 80C to 80U. You get the total income. Then we'll go for the resident status meaning. Resident status is a term coined under the Income Tax Act and has nothing to do with nationality or domicile of a person. Residential status of a person depend upon the territorial connection of the person within this country. That is, for how many days he has physically stayed in India. Then we go for the classification of residential status. First we classify resident. Next, resident but ordinary resident. Then third one, resident but not ordinary resident. The last one, non-resident. First we will see the resident. A resident will be charged to tax in India on its global income, that is, income earned in India as well as income earned outside India. They need not pay any tax in India on their foreign income. If he or she stay in India for a period of 180 days or more in a financial year, or she is in India for a period of 60 days or more in a financial year, and if he or she stays in India for a period of 365 days or more during the 4 years immediately preceding the previous year. Then, resident but ordinary resident. As per Section 6, Subsection 6 of the Income Tax Act 1961, there are following two conditions when an individual will be treated as resident but ordinary resident. First one, if he or she stays in India for a period of 730 days or more during the 7 years of preceding previous year. Then second one, if he or she stays in India for at least 2 out of 10 previous financial year which is preceding the previous year. Then resident but not ordinary resident. In the above, if an individual meet any of the first conditions stated above but do not meet the additional condition, he or she shall be considered a resident but not ordinary resident. Then we go for the non-resident. An individual will be qualified for non-resident if he or she satisfies the following conditions, which are as follows. In a financial year, if an individual stay in India for less than 181 days, and in a financial year, if an individual stay in India for not more than 60 days, if an individual stay in India which exceed 60 days in a financial year but does not exceed 365 days or more during the 4 previous financial years. Then what are the steps required to calculate the residential status of an individual? First, we check whether the individual is falling under the category of exception for the basic condition or not. After that, we check that whether they are satisfying the basic condition of 180 days or more or not. If they are satisfying, then he will be treated as a resident. Otherwise, he will be considered as a non-resident. If an individual is not fulfilling the above condition, then we apply both the condition, and if he satisfies any one of the basic condition take, then he is said to be a resident. Now we will see the rules and regulations of the resident status. First we will see the basic condition. First one, a stay of 180 days or more during the current previous year, or a stay of 60 days or more in the current previous year, and a total stay of 365 days or more in the 4 years immediately preceding the current previous year. Then additional condition, he should be a resident in India at least 2 out of 10 years immediately preceding the current previous year, and a stay of 730 days or more during the 7 years immediately preceding the current previous year. See, they given the note here. In case an Indian citizen who goes abroad in the previous year for employment or as a member of the crew of an Indian ship, 60 days should be taken as 182 days. In case of an Indian citizen who stays abroad comes on a visit to India during the previous year, 60 days should be taken as 182 days. Then we go for the statuses. First one, a resident who satisfies any one of the basic condition. Then ordinary resident who satisfy any one of the basic condition and both the additional condition. Not ordinary resident who satisfy any one of the basic condition but does not satisfy any one or none of the additional condition. Non-resident who does not satisfy basic condition itself. Then individuals have 3 status, namely ordinary resident, not ordinary resident and a non-resident. The day of arrival and the day of departure are considered as a separate day irrespective of the time of arrival or departure. It puts in your status in a nutshell there. First, resident, basic condition but not additional condition. Second one, resident and ordinary resident, basic condition plus additional condition. Then third one, resident and not ordinary resident. Okay, you should satisfy the basic condition and not need to satisfy the additional condition. The non-resident will not satisfy both basic condition as well as additional condition. Next, we will see the status of Hindu undivided family, section 6, subsection 2. A HUF can have the following status. First one, ordinary resident. Then second one, not ordinary resident and non-resident. So just we see in the tabular column, under the resident column, when control and manage is only situated in India. Second one, when control and management is partly situated in India and partly situated outside India. For non-resident, when control and non-management is only situated outside India. Then we will see the ordinary resident or not ordinary resident. First one, it is only the HUF which can have this ordinary resident or not ordinary resident status apart from the individual. Second one, an HUF can have this status depending on the satisfaction of additional condition by the Karta or manager of the family. If the Karta satisfies additional condition mentioned, then the HUF will get the status ordinary resident. If the Karta does not satisfy the additional condition mentioned, then the HUF will get the status not ordinary resident. Then fifth one will see the additional condition same as mentioned for individuals. He should be resident in India in at least 2 out of 10 years immediately preceding the current previous year, and a stay of 730 days or more during the 7 years immediate preceding the current year previous year. Then the last one, and HUF can have three statuses, namely ordinary resident, non-ordinary resident and non-resident. Then we will see the status of a company, section 6 subsection 3. The resident status of the company can be studied after classifying the company into two groups as follows: Indian company and foreign company. Indian company, an Indian company is always a resident. There is no specific route to Indian company. Whereas in case of foreign company, a foreign company can have the following two status. First one, resident, and another one is non-resident. We will see the rules and regulations for foreign company. First, resident, when control and management is fully situated in India. Non-resident, when control and management is partly situated in India and partly situated outside India. Second one, when control and management is fully situated outside India. Just you will see the note here. First one, company can have only two status. For Indian company, it is not necessary to look for the control and management since all Indian companies are resident only. From assessment year 2017-18, resident foreign company is based on place of effective management. It is as per the principles issued by the board to avoid double taxation. It is also recognized and accepted by Organization of Economic Cooperation and Development. Then we will have the status of firm, AOP, Association of Person, section 6 subsection 2. Body of individuals, BOI and other person, section 6 subsection 4. The resident status of firm, association of person, body of individual and other person can have the following two status. First one, resident, second one is non-resident. Under the resident, first one, when control and management is wholly situated in India. Second one, when control and management is partly situated in India and partly situated outside India. In case of non-resident, when control and management is wholly situated outside India. Next we will see the incidence of tax or scope of total income. Section 5 deals with the scope of total income. The scope of total income depends on the residential status of a particular person. The total income liable to tax will vary according to the residential status of a particular person gained in a particular previous year. The following table will show the tax incident for different residential status. We will see the types of income: ordinary resident, not ordinary resident and non-resident. First one, any income received or deemed to be received in India, whether accrued in India or outside India, it is taxable under the three cases, that is ordinary resident, not ordinary resident and non-resident. Then second one, any income accruing or deemed to accrue in India, whether received in India or outside India, it is also taxable in three heads. Then third one, income received outside India from a business or profession controlled from India, it is taxable under two heads, that is ordinary resident and not ordinary resident. It is not taxable under non-resident. Then the next one, income received outside India from a business or profession controlled from outside India, it is taxable only under the case of ordinary resident. It is not taxable under not ordinary resident and non-resident. Then the next one, income received outside India from any other source apart from business, it is taxable only ordinary resident. It is not taxable under not ordinary resident and non-resident. Then the next one, past untaxed profit brought into India and income earned outside India in earlier years but later on remitted to India, it is not taxable under the three heads, that is under ordinary resident, not ordinary resident and non-resident. Then we will see the note here. First one, gift received from a person other than relative or at the time of marriage or by will is taxable provided the amount is above 50,000. The whole amount should be taxed. Section 56 subsection 2 schedule 6. If it is received outside India, it is taxable only for ordinary resident. If it is received in India, it is taxable for all. Then second one, Dividend from an Indian company is not taxable under section 10 subsection 34. Salary drawn outside India from an Indian company is taxable only for resident, but if it is services rendered in India, then that portion is taxable to all. Next we will see the meaning of exempted income. Any income earned which is not subject to income tax is called exempt income. As per section 10 of the Income Tax Act 1961, there are certain types of income which will be subjected to income tax within a financial year provided they meet certain guidelines and conditions. Next we will see the income exempted from tax as per section 10. Exempted income under section 10. Section 10 of the Income Tax Act deals with the exempted incomes. Exempted income are those income which do not form part of the total income. In other words, these income are not included in the total income of an assessee for income tax purposes. First one, section 10 subsection 1, exempted income, agricultural income. Second one, 10 subsection 2, received from Hindu undivided family. Then third one, 10 subsection 2a, partners share in the firm. Then section 10 subsection 4, schedule I, interest on securities, bond for non-resident. Then section 10 subsection 4, schedule 2, interest on external account of a non-resident. Then section 10 subsection 4b, interest on specific savings certificate. Section 10 subsection 5, value of leave travel concession. Then section 10 subsection 6a, tax paid on behalf of a foreign company. Section 10 subsection 6b, tax paid on behalf of non-resident or foreign companies in respect of other income. Section 10 subsection 6c, royalty or fee for technical services. Section 10 subsection 7, allowances or perquisite for service rendered outside India. Section 10 subsection 8b, income in connection under a technical assistance program. Section 10 subsection 10, gratuity. Section 10 subsection 10a, commuted pension. Section 10 subsection 10a, leave encashment. Section 10 subsection 10b, any compensation to an employee. Section 10 subsection 10bb, payment under Bhopal gas leak disaster, processing of claims Act 1985. Section 10 subsection 10bc, compensation on account of a disaster received or receivable from central or state government or local authority by an individual or his legal heir. Then section 10 subsection 10c, voluntary retirement payment. Then next one, section 10 subsection 10cc, tax paid by employer or income by a way of perquisite on behalf of an employee. Then section 10 subsection 10d, from assessment year 14-15, payment or bonus under insurance policy issued on or after 1/4/2013 on the life of a person suffering from disability, severely disability referred under section 80U or under section 80DDB. Then section 10 subsection 11, provident fund payment including interest. Section 10 subsection 12, accumulated balance of recognized provident fund. Then section 10 subsection 12a, from assessment year 2017-18, amount payable from the National Pension System Trust referred in 80 CCD, 40% of the total amount payable. Then section 10 subsection 13, superannuation fund payment, pension scheme notified under section 80 CCD from assessment year 2017-18. Then section 10 subsection 13a, house rent allowances. Section 10 subsection 14, special allowance to employees. Section 10 subsection 15, schedule 2b, interest on capital investment bonds. Section 10 subsection 15, schedule 3c, interest payable to European Investment Bank. Section 10 subsection 15, schedule 4 class I, interest on retirement benefit. Section 10 subsection 15, schedule 5, interest on securities and deposit. Section 10 subsection 15, schedule 6, interest on gold deposit bond 1999. Section 10 subsection 16, scholarship granted to meet the cost of education. Section 10 subsection 17, allowances to MPs and MLAs with effect from assessment year 2007-18. Constituency allowance received is also exempted without any limit. Section 10 subsection 17a, amount in connection with cash or kind award instituted by central or state government. Section 10 subsection 18, pension or family pension received by central or state government employee. Section 10 subsection 19, Family pension received by a widow, children, nominated heads of a member of armed forces. Section 10, subsection 19A, annual value of one place in the occupation of an ex-ruler. Section 10, subsection 20, income of local authority, municipality, panchayat, district boards. Section 10, subsection 21, income of an approved scientific research association. Section 10, subsection 22B, income of a news agency. Section 10, subsection 23BB, income of Qadi and village board. Section 10, subsection 23 BBA, income of religious institution, etc. Section 10, subsection 23 BBB, income of European Economic Community. Section 10, subsection 23 BBC, income of SAR fund for regional project. Section 10, subsection 23 BBBD, income of ASOSAI Secretariat, Asian Organization of Supreme Audit Institution from assessment year 2001 to 2010 to 11. Section 10, subsection 23 BBE, income of Insurance Regulatory and Development Authority. Section 10, subsection 23 BBF, income of North Eastern Development Finance Corporation Limited. Section 10, subsection 23 BBG, income of Central Electricity Regulatory Commission with effect from assessment year 2008 to 2009. Section 10, subsection 23 BBH, income of the Prasar Bharati Broadcasting Corporation of India. Section 10, subsection 23C, income of certain relief fund. Section 10, subsection 23C, schedule 3A, income received by the National Foundation for Communal Harmony. Section 10, subsection 23C, 3AB, AC, AD, E, schedule 6 via income of education institution, hospitals and medical institution. Section 10, subsection 23C, schedule 4 and schedule 5, income of notified bonds, charitable, religious institution or trust. Section 10, subsection 23D, income of mutual funds. Section 10, subsection 23DA, from assessment year 14-15, income of secularization trust from the activity of securitization. Section 10, subsection 23EA, income of a notified investor protection fund set up by regulated stock exchange in India with effect from assessment year 2007-8. Section 10, subsection 23EB, income of credit guarantee fund trust for small industries, assessment year 2002, 2003 to 2006 to 2007. Section 10, subsection 23EC, income of investor protection fund by way of contribution from commodity exchange and members thereof with effect from assessment year 2008 to 2009. Section 10, 23ED, from assessment year 14-15, income of notified investor protection fund set up by a depository by way of contribution from a depository. Section 10, subsection 23EE, from assessment year 2016-17, specified income of a notified settlement guarantee fund recognized. Section 2010, 23FB, income of venture capital company or venture capital fund from investment in a venture capital undertaking with effect from assessment year 2008-2009. Section 10, subsection 23 FBA, from assessment year 2016-17, income of investment fund except business or profession. Section 10, subsection 23 FC, from assessment year 15-16, income of a business trust by way of interest from a special purpose vehicle. Section 10, subsection 23 FD, from assessment year 15-16, income received by a unit holder from the business trust. Section 10, subsection 24, income of trade union or association of trade union. Section 10, subsection 25, income of statutory provident fund. Section 10, subsection 26, income of member of scheduled tribes. And section 10, subsection 26, AAB, income of an agriculture produce market committee or board regulating the marketing of agriculture produce with effect from assessment year 2009-10. Section 10, subsection 30 and 31, subsidy from tea board. Section 10, subsection 32, income of a minor child up to a maximum of 1500 per minor child. Section 10, subsection 34, dividend by domestic company, dividend referred in section 115.0 should not be included. Section 10, subsection 34A, from assessment year 14-15, income arising to a shareholder from buyback of shares of an unlisted domestic company. Section 10, subsection 35, interest on units of mutual fund. Section 10, subsection 35A, from assessment year 2017-18, income received up to 31st May 2016 from a securitized trust by an investor of such a trust. Section 10, subsection 36, long-term capital gain arising on transfer of eligible equity share of a company acquired on or after 1/3/2003 but before 1/3/2004 and held for 12 months or more. Section 10, subsection 37, capital gain income arising on compulsory acquisition of agricultural land in urban areas. Section 10, subsection 38, income from transfer of equity shares of a company or units of an equity-oriented fund not covered by securities transaction tax. From assessment year 2015-16, capital gain arising on transfer of units of a business trust which were acquired against transfer of shares in a special purpose vehicle to that business trust will not be exempted under this clause. Section 10, subsection 39, income from notified international sporting event held in India. Section 10, subsection 40, grant received by a subsidiary company from Indian holding company engaged in the business of generation or distribution of power. Then section 10, subsection 41, capital gain arising due to transfer as mentioned in 10, subsection 40, business above. Section 10, subsection 42, specified income of a notified non-profit body or authority. Section 10, subsection 43, amount received by an individual as a loan in a reverse mortgage transaction, either an installment or lump sum. Section 10, subsection 44, income of new pension system trust. Section 10, subsection 45, notified allowances are perquisite to chairman, retired chairman or member or retired members of UPSC. Then section 10, subsection 46, specified income of a notified body, authority, board, trust or commission set up by state central government for public benefit. Section 10, subsection 47, income of a notified infrastructure debt fund. Section 10, subsection 48, income of a notified foreign company. Section 10, subsection 49, income of a national financial holding company limited. Section 10, subsection 50, income arising from any specified services provided on after the date of enforcement of equalization levy and chargeable to such levy. Next, we will see the agriculture income. We will see the meaning of agriculture income. Agriculture income refers to income earned or revenue derived from sources that include farming land, building on or identified with an agricultural land and commercial produce from a horticultural land. Agriculture income is defined under section 2(1)(a) of the Income Tax Act 1961. Then we will see the definition of agriculture income. Under section 2, subsection 1(a), any rent or revenue derived from land which is situated in India and used for agricultural purposes. Section 2, subsection 1(a), schedule A. Then, any income derived from such land by agricultural operation, including processing of the agricultural produce raised or received as rent in kind, so as to render it fit for the market, or sale of such produce. Then, income attributable to a farmhouse subject to the condition that the building is situated on or in the immediate vicinity of the land and is used as a dwelling house, storehouse or other outbuilding, and the land is assessed to land revenue or a local rate, or alternatively the building is situated on or in the immediate vicinity of land which thought not assessed to land revenue or local rate is situated in a rural area. Next, we will see the computation of agricultural income. Income from agriculture under the heading income from self-cultivated land, rent of agricultural land, annual value of house given to tenant, less expenses in connection with agriculture. Under that, interest on loan borrowed to purchase agricultural land, collection charges, land revenue, labor charges, depreciation of equipment, purchase of seed and fertilizers. Next, we will see the examples of agricultural income. The following are some of the examples of agricultural income. Income derived from sale of replanted trees, income from sale of seeds, rent received from agricultural land, income from growing flowers and creepers, profit received from a partner from a firm engaged in agricultural produce or activities. Next, we see the examples of non-agricultural income. The following are some of the examples of non-agricultural income. Income from poultry farming, income from bee hiving, any dividend that an organization pays from its agricultural income, income from the sale of spontaneously grown trees, income from dairy farming, income from salt produced after the land has flooded with seawater. How to separate agriculture and non-agricultural income? First, you see the income from crop. First one, growing and manufacturing tea in India. If it is agricultural income, 60%. Non-agricultural income is 40%. Rule 8 applies. Then, income from crop. Manufacture of latex or latex-based trips or brown trips or technically specified block rubbers. 65%, 35%. 7-year rule applies. Coffee grown and cured by seller. 75% for agricultural income, non-agricultural income 25%, rule 7b subsection 1 applies. Coffee grown, cured, roasted and grounded by the seller in India with or without mixing chicory or other flavoring ingredients. Agriculture income 60%, non-agriculture income 40%, Rule 7B 1A. Then we see the integration procedures. Procedure for integration. Step 1. Aggregation of both income. Net agriculture income is to be added with non-agriculture income. Step 2. Computation of tax on total income. On the total income arrived at in first step, tax is to be calculated at the rate applicable. Step 3. Addition of net agriculture income to the exempted limit for income tax. The net agriculture income is to be added with the exempted income of rupees 2,50,000, rupees 3 lakh in the case of a resident senior citizen of 60 years or more, rupees 5 lakhs in case of super senior citizen who is the age of 80 years or more. Step 4. Computation of tax. On the total amount of income has arrived, in step 3, tax is to be calculated at the rates applicable. Ascertainment net tax. From the tax calculated in step 2, tax calculated in step 4 is deducted to arrive at net tax, and the rebate under section 87A is deducted if applicable. Education cess is added at 2% of tax, and secondary and higher education cess 1% of tax. Next we'll see the meaning of salary. A salary is a form of payment from an employer to an employee which may be specified in an employment contract. It is contracted with the piece wages where each job, hour or other unit is paid separately rather than on a period basis. How salary is defined? It is defined in wages, any annuity or pension, any gratuity, any fee, commission, perquisite or profit in lieu of salary or in addition to any salary or wages, any advance of salary, any payment received by an employee in respect of any period of leave not availed by him, the portion of the annual accretion any previous year to the balance the credit of an employee participating in a recognized provident fund to the extent it is taxable, transferred balance in a recognized provident fund to the extent it is taxable, and contribution by the central government to the account of an employee under a pension scheme referred to it in section 80 CCD. Then just we will see the features of the salary. First one, relationship of employer and employee. For a payment to fall under the head salary, the relationship of employer and employee must exist between payee and the receiver of the salary. The employer may be government, a local authority, a company, or any other public body, or an association, or HUF, or even an individual. Every kind of payment to every kind of servant, public or private, however high or low place he may be, is covered under the provision of this Act. Even the remuneration payable to an employee of a foreign government falls within this section. Even servant is an employee, but an agent may or may not be an employee. Then second one, salary from more than one employer. Any amount of salary received or due from one or more than one employer or source shall be taxable under this head. Such a situation may arise when an employee is working within two employers simultaneously or has worked with one employer and later on serves with another employer after leaving service with the first employer. Salary from both the employers shall be taxable under this head. Then third one, salary from present, past or prospective employer. Salary received or due from present, past or future employer is also taxable under this head. Then next, tax-free salary. Sometimes the employer allows an employee to draw tax-free salary. Example, employer pay full salary to employee and also pay tax on this directly to the department. The employee assessment is to be made not on the amount of salary he is drawing but on gross amount, that is salary drawn plus the tax paid by the employer. Salary received as a member of parliament. Salary received by a member of parliament is not taxable under the head salaries. It is taxable as income from other sources. Any allowances received by them is fully exempted from tax. The next one, receipt from person other than employer. Perquisites or benefit or any other remuneration received from person other than the employer would be taxable not under the head salary but under the head income from other sources, even if they accrue to the employee by reason of his employment or while he was discharging his normal duty. Then we will go for the advance salary received. In case an assessee received some salary in advance in a previous year which was actually not due in that year, it shall be taxable in the year of receipt. In case any loan or advance is taken, it is not treated as advance salary. Then arrears of salary received. Any amount of salary received from present or past employer during the relevant previous year and which relate to some earlier previous year is treated as arrears of salary. It is taxable in the year in which received and not that the year to which it belongs. Salary in lieu of notice. To terminate the service of an employee, it is essential to serve a notice as per service agreement. In case it is decided to relieve the employee immediately, he is given salary in lieu of such notice period. Such amount is fully taxable under the salary on receipt basis. We will see the format to compute salary income. First we will go for the basic items. Under the basic item, first one basic salary, wages, remuneration, pay, then special pay, then bonus, then fees, then commission, then advance salary, then arrears salary. Then allowances. Under the allowances, we have the fully taxable allowances, partly taxable, partly exempted allowances, and fully exempted allowances. Then perquisites. Under the perquisites, first we will have the taxable for all, specified and unspecified. Then second one, taxable for specified employee only. Then third, exempted for all, specified and unspecified. Then we have the special items. Under the special items, we have the gratuity, pension, leave encashment, provident fund. Then we get the gross salary. So, when we are going for a meaning of salary, we just calculate for different purposes. For example, HRA will include basic salary, DA forming part of salary, and person of commission. Then we go for the entertainment allowance. We will take only basic salary. And against provident fund, we take the basic salary, dearness allowances, and the person of commission. Under the gratuity, we take the meaning of salary, that is basic salary, DA forming part of salary, then person of commission. Then we have the leave encashment. Under the leave encashment, the meaning of salary will be taken into consideration, basic salary, DA forming part of salary, then person of commission. For pension, we take the meaning of salary, basic salary, DA forming part of salary, then person of commission. Then for rent-free house, we have meaning of salary will be taken into consideration, basic salary, DA forming part of salary, then person of commission, bonus, fees, commission, plus other taxable allowances. Then monetary salary, basic salary, DA forming part of salary, DA not forming part of salary, person of commission, bonus, fees, commission, then other taxable allowances. Next we will see the heading allowances. First we will see the meaning of allowances. Allowances is a fixed amount of money given along with salary in order to meet some particular requirement connected with the service rendered by the employee. It is taxed on due or received basis. Allowances are generally classified into three categories. First, fully taxable allowances. Second one, partly taxable or partly exempted allowances. Third, fully exempted allowances. Now we will see the fully taxable allowances. The list of fully taxable allowances is as follows. Differ from company to company as per company allowances. First we will have the dearness allowances. This allowance is paid to employees to adjust their cost of living to cope up with inflation, is fully taxable. Then city compensatory allowances. Fully taxable allowance of salary generally given to employees working in big cities to compensate for higher standard of living. Next, fixed medical allowances. It is fixed allowance paid by a company per month to employee whether they submit bill or not. It is fully taxable, but employees can claim tax benefit up to Rs 15,000 under Mediclaim reimbursement. Bills and supporting document required in this case. Then tiffin or lunch or dinner or refreshment allowances. Any allowance paid by company for tiffin or lunch or dinner or refreshment is fully taxable. Servant allowances. When an employer pays an employee to engage service of a servant, such an allowance is taxable. Project allowances. Any amount paid to employee who are involved in project or settle expense incurred during project on behalf of company. Overtime allowances. Any amount paid for overtime is fully taxable. Telephone allowances. Telephone allowance is fully taxable. However, telephone bill reimbursement is fully exempted. Then we'll see the partly taxable allowances. Transport allowances. Under the transport allowances, any amount paid to employee for expenses incurred on commuting between residence and place of duty. House rent allowances. Any allowances paid by employer to pay employee rented accommodation exempted. List of the following three is exempted. Actual HRA received 40% of salary. Suppose 50% is house situated in Mumbai, Calcutta, Delhi or Madras. Actual rent paid minus 10% of salary. Then next we will see the conveyance allowances. Any allowances paid by employer to meet expenses incurred in connection with performing office duties. Next, children education allowances. It is a reimbursement for education expenses incurred for 2 children. Next, hostel expenditure allowances. Any allowances granted to an employee to meet the hostel expenditure of his child. Uniform allowances. In this case, according to dress code of the office, an employee can claim uniform reimbursement for formal cloth purchased for office wear. Does not necessary for workers in factory. It is for all employees who have to follow certain dress code in office and its maintenance. Research allowances. It is granted for encouraging the academic research and other professional pursuit. Then helper or assistant allowance. Exempted to the extent of expense incurred for official purpose, varying from company to company as per their policy. Then allowance to meet travel cost and transfer, exempted to the extent of expenses incurred for official purpose. Then daily allowances. Daily allowance is given to meet the ordinary daily changes incurred by an employee on account of absence from his normal place of duty. Then island duty allowances for armed forces. It is granted to members of armed forces in Andaman and Nicobar and Lakshadweep group of islands, subject to certain condition and location. Highly active field area allowances for armed forces, subject to certain condition and location, exempted up to Rs 4,200 per month. High altitude allowances for armed force. It is granted to armed force operating in high altitude areas, subject to certain condition and location, exempted up to 1,060 per month for altitude of 9,000 to 15,000 feet. Then we'll see the non-taxable allowances. The allowances given to an employee which form a part of their salary but are fully exempted from tax are called non-taxable allowances. Below is a list of allowances which form part of non-taxable allowances. Types of non-taxable allowances. Allowance paid to government employee abroad, allowance paid to UNO employee, allowance paid to judges of High Court and Supreme Court, compensatory allowances. Next we'll see the allowance chart. Under the allowance chart we have the fully taxable, partly taxable and fully exempted. Under the fully taxable allowances, we have the day and allowances, city compensatory allowances, project allowances, fixed medical allowances, stipend allowances, servant allowances, non-practicing allowances, wardenship allowances, deputation allowances, wartime allowances, marriage allowances, family allowances, lunch allowances, dinner allowances, special allowances, holiday trip allowances, petrol allowances. Under partly taxable allowances, house rent allowances, entertainment allowances, hill allowances, tribal area allowances, education allowances, hostel allowances, traveling allowances, conveyance allowances, academic research allowances, washing allowances, helper allowances, daily allowances, uniform allowances, allowance for transport employees, transport allowances, underground allowances, high altitude allowance, highly active field area allowances, island duty allowances, field area allowances, modified area allowances, insurgency allowances, and fully exempted foreign allowances, then cemetery allowances, out of pocket allowances, allowance to employees of UNO, then transport allowances, then allowances received by a teacher or professor from SARC member states. Next we will see how to calculate taxable or exempted house rent allowances. Actual HRA received less exempted, actual HRA, rent paid minus 10% of meaning of salary, 40% or 50% of salary, whichever less is exempted. With regard to salary, meaning of salary, basic salary plus DA forming part plus fixed percent of commission should be taken into consideration. 50% of salary is to be considered in case of Delhi, Mumbai, Calcutta and Chennai, and 40% in other cases. Then we will see the entertainment allowances. For government employee, least of the following is exempted. Actually, he received absolute limit rupees 5,000, 20% or 1/5 of the basic salary, whichever is exempted under section 16. Note, only basic salary or pay to be considered. For non-government employee, including employees of statutory corporation or local authority, all employees except central and state government, no deduction under section 16, full amount is taxable. Next, how to calculate exemption for leave salary. For government servant, it is not taxable, fully exempted. For non-government servant, including local authority and public sector undertaking, EA received list of the following is exempted. Actual leave salary received, 10-month average salary, then maximum limit 3 lakhs, salary for unutilized eligible leave, consider 30 days per year. Fraction service to be omitted. Salary means average salary, whichever is exempted. Gratuity. Death cum retirement gratuity. Section 10. Gratuity is a retirement benefit. It is paid at the time of retirement or cessation of employment based on the service. For tax treatment, the status of the employee is divided into two main categories as follows. First one, government employee and non-government employee. Under the category, we just covered employment payment of Graduate Act 1972. Employee is not covered by the payment of Graduate Act 1972. The following tax treatment should be given in order to identify taxable or exempted gratuity for government or non-government employee. With regard to exemption for gratuity, for government employee, it is fully exempted. For non-government employee, yes, it has been categorized two categories. First one, covered by the payment of Graduate Act 1972, not covered by the payment of Graduate Act 1972. Under the payment of Graduate Act 1972 covered, list of the following is exempted. Actual gratuity received, maximum 10 lakhs, 15 days salary for every year of completed service, whichever less is exempted. With regard to employee not covered by payment of Graduate Act 1972, list of the following is exempted. Actual gratuity received, maximum limit 10 lakhs, half month average salary for every year of completed of services, whichever less is exempted. Next we will see the pension. It is a periodic payment received by an employee after his retirement. An employee cannot receive pension while he is in service. Any pension received is taxable as salary. There are two types of pension. One is commuted and another one is uncommuted. Commuted pension, it is a lump sum amount received at the time of retirement. It is a one-time payment. Whereas uncommuted pension, it is a periodic payment received by the employee after the date of retirement. It is a balance which he gets after commutation. The following are the rules on which pension is taxed. For government employee includes employees of central, state government, local authority, statutory, corporation, it is fully exempted. For non-government employee, received with gratuity, 1/3 of the full amount pension is exempted. Received without gratuity, 1/2 of the full pension is exempted. Next we will see the perquisite. We will see the definition of perquisite. As per section 17 subsection 2, it may be defined as any casual emolument or benefit attached to an office or position in addition to salary and wages. It also denotes something that benefit a man by going in his own party. Perquisites may be provided in cash or in kind. However, perquisites are taxable on their salary only if they are allowed by an employee to his employee, allowed during the continuance of employment, directly dependent upon services, resulting in the nature of personal advantage to the employee and derived by virtue of employer's authority. Now we will see the chart with regard to perquisites. Taxable for all specified and unspecified, taxable for specified employee only, exempted for all specified and unspecified with certain limit. First we will see the taxable for all specified and unspecified. First one, rent-free house. Under the rent-free house, we have the furnished house and second one is unfurnished house. Then second one, house at consumption rent. Then third one, any obligation of employee paid by employer. Then fourth one, any amount paid by employer to effect on assurance on the life of employee. Then free meal, then gift, then club facility, then credit card and add-on card, then use of movable asset except computers and laptop, and interest on free loans. Next we'll see the taxable for specified employee only. Motor car. Second one, domestic servant like watchman, gardener, sweeper, any personal attendant, cook. Then supply of gas, electricity or water. Then education facility. Then transport facilities other than railways and airlines. Then we'll see the exempted for all specified and specified with certain limit. First one, medical facilities. Free medical facilities fully exempted. Reimbursement. Then approved government, employer hospital fully exempted. Private hospital up to 50,000. Medical facility outside India as permitted by RBI. Then second one, interest free concession loan. Loan amount not exceeding 20,000. Then third one, interest free loan for medical treatment of the nature given in Rule 3A, full amount is exempted. Next we will see the perquisites taxable for all specified and unspecified. First one will go for the rent free house. Under the rent free house, we have the unfurnished house. First case, in case of central or state government employees, rent fixed or license free fixed as per government rules. Note for High Court, Supreme Court judges, it is exempted fully. Second, in case of private sector or other employees, all those who are not covered in section A, value depends on salary of employee and lease rent of accommodation. We will see the city population as per 2001 census, house owned by employer, house taken on lease or rent paid by the employer. With regard to the first category, population exceeding 25 lakhs, 15% of salary with the houses owned by employer. Then population exceeding 10 lakhs but up to 25 lakhs, 10% of salary. Then other places 7.5% of salary. In case of house taken on lease or rent paid by employer, lease rent paid or payable or 15% of salary, whichever is less is taxable. Next we will see the furnished house. Under the furnished house, value of unfurnished house calculated as above. Add 10% of cost of furniture or full hire charges paid or not. If furnished is owned by employer, furniture includes radio set, TV, refrigerator, AC and other household appliances. Value of taxable perquisites. If accommodation provided in a hotel from 1st April 2001, 24% of salary paid or payable or actual charges paid or payable to hotel, whichever is lower is taxable. If following condition is satisfied, nothing is taxable. Then house at concession rent. Value of rent free house calculated as above, less rent charged by employer. Tax value of perquisite. Then salary. With regard to salary, we just take into basic salary DA. forming part of salary plus bonus plus fees plus commission plus all taxable allowances plus all other monetary payment plus leave encashment of this current year. Salary does not include DA not forming part, exempted allowances, value of any perquisite, bonus of daily arrears, employer contribution to provident fund account of employees. Then third one, free meal taxed if exceed 50 per meal provided in workplace, taxed if amount is above 50, provided in remote area is not taxed, provided in office hours and workplace is taxed. Any amount paid by employee can be reduced. Fourth one, gift in kind if it exceeds 5,000, gift in cash or gift check are not exempted. Then next one, credit card or club expenditure. Expenditure incurred by employee for the card used by employee minus official purpose expenditure. Then the balance amount will be deducted from the record amount from employee. That will be the taxable value. Next one, use of movable asset other than laptop and computers. 10% of actual cost or amount paid or charged by the employer less amount paid or account from the employee. That will be the taxable amount. Then interest-free loan. Interest-free or concession loan made available to an employee during the previous year by the employer will be based on the rate charged per annum by SBI on first day of the relevant previous year. Interest is calculated on the maximum outstanding monthly balance as reduced by the interest actually paid by the employee. It is not chargeable tax in the following cases. If his loan is for medical treatment in respect of diseases specified in Rule 3A, if loan amount does not exceed 20,000 in aggregate, petty loan. Next we will see the motor car, okay, which is a perquisite taxable for specified employee only. How to treat motor car perquisites? First one, provided owned by employer to employee. For office use only, it is fully exempted. For private use only, taxable amount will be actual expenditure minus amount received from employee. For both official and private use, we have the two categories. First one, small car up to 1.6 liter cubic capacity or 1600 cc. Then second one, big car above 1.6 liters cubic capacity or 1600 cc. When expenses are not made by employer, 1800 per month for small car. For big car, it is 2400 per month. When expenses are made by the employee himself, 600 per month for small car and rupees 900 per month for big car. Then, if driver or chauffeur is provided, 900 per month as salary should be taxed. Month means a complete month and a fraction of month, if any, is to be ignored. Then, second one, owned by employee himself. When expenses are met or reimbursed by the employer, car used for official purposes, it is fully exempted. Car used for private purposes, taxable amount will be actual expenditure minus amount received from employee. Then, car has been used for partly and official and personal purpose, actual expenditure minus amount as per the above table, 1800 or 2400 as the case may be. Next, amount received from employee will be deducted, then the balance will be the taxable amount. When expenses are met by employee, it is fully exempted. Valuation in case of two or more cars. One car as opted by the employee should be valid as mentioned A. All other cars should be taxed and mentioned A subsection B for private uses. Then we see the domestic servants. Total salary paid or payable by employer or any other person less actual amount paid by employee, then the balance amount will be taxable value. If domestic servant are appointed by employee but salary paid by employer, then it is an obligation of employee paid by employer. So it is taxable for both specified and unspecified employee. If provided along with house, then it is not taxed separately. It is added with the fair under value of the house. Domestic servant allowance is fully taxable to all since it is not a perquisite. Next one, we will see the supply of gas, electricity and water. If supplied from own source, tax on the basis of manufacturing cost per unit incurred by the employer. If supplied after purchasing the same from an outside agency, actual amount paid to the agency by the employer is taxable. Note, if any amount is charged from the employee, then that amount can be deducted. Then fourth one, we have the education facilities. Free education facilities and training to employee is not taxable. School fees of family members of employees paid by the employer directly to the school is taxable as a perquisite for all employees. Then reimbursement of school fees of employee children is also taxable for all employees. If education is provided in employer institute itself, cost of education in similar institute less 1000 per month per child, then the balance amount will be taxable value. Then transport facility. Transport facility provided by a transport undertaking engaged in carriage of goods or passengers to an employee and family members of the employee, either free of charge or at concession date is not taxable provided conveyance used for this purpose is owned by the employer. Then privileged passes and privileged ticket to railway employees and similar facility made available to employees of Air India and Indian Airline is not taxable. In other case, the actual amount spent by employee is taxable. Then we'll see the meaning of profit in lieu of salary. Profit in lieu of salary are payment received by an employee in addition to the regular salary. The profit in lieu of salary can include both monetary and other forms of compensation. Profit in lieu of salary is taxable under the Income Tax Act and must be declared while filing income tax return. We see how to compute the profit in lieu of salary. Section 17, subsection 3 gives an inclusive definition of profit in lieu of salary. As the name suggests, this payment are received by the employee in lieu of and in addition to salary or wages. This payment includes the following: terminal compensation, the amount of any compensation due to or received by an assessee from his employer or former employer at or in connection with the termination of his employment or the modification of the terms and conditions relating thereto is regarded as profit in lieu of salary. The termination may be due to retirement, premature termination, resignation or otherwise. Then payment from unrecognized provident fund or unrecognized superannuation fund. The next category of such profit in lieu of salary is payment due or received by an assessee from unrecognized provident fund or an unrecognized superannuation fund to the extent to which such payment does not consist of contribution by the employee or interest on such employee contribution. In other words, total employer contribution till date and interest on such employee contribution would be both taxable. Employer contribution and interest thereon and interest on the employee contribution are not taxed during the period of employment. When the accumulation balance of such a fund is paid to the employee either on retirement or on termination of service, the untaxed portion, that is, the employer contribution and interest thereon, is taxed as profit in lieu of salary. The interest of employee contribution is taxed as income from other sources. Payment under keyman insurance policy. Any payment due to or received by an employee under a keyman insurance policy, including the sum allotted by way of bonus on such a policy, will also be regarded as profit in lieu of salary. Then, any amount due or received before joining or after cessation of employment. Any amount due or received, whether in lump sum or otherwise, by an assessee from any person before his joining an employment with that person or after cessation of his employment with that person. Then, any other sum received by the employee from the employer. All other payment made by an employer to an employee would be brought under the head profit in lieu of salary. This is a comprehensive provision by virtue of which all payment made by employer to employee, whether made in person of legal obligation or voluntarily, are brought under profit in lieu of salary. However, the following receipt will not be termed as profit in lieu of salary to the extent they are exempted under section 10. Death cum retirement gratuity, section 10, subsection 10. Commuted value of pension, section 10, subsection 10A. Retrenchment compensation received by a workman, section 10, subsection 10B. Payment received from a statutory provident fund, section 10, subsection 11. Payment received from a recognized provident fund, section 10, subsection 12. Any payment from approved superannuation fund as per section 10, subsection 13. House allowances exempted under section 10, subsection 13A. In short, except for the terminate and other payment received exempted. Under class 10 to 13A of section 10 and all other payment received by an employee from an employer or formal employer are liable to tax under this head. Next we will see the provident fund. It is a scheme where the employee contributes a sum of money from his monthly salary towards savings. Similarly, the employer will also contribute some amount to the account of employee. The interest earned out of this contribution is also credited to his account itself. If an employee wants to get a loan during his service, he can apply for and get the same from his account. The accumulated sum of money to the employee's account will be paid to him at the time of retirement. In case of death of the employee, the sum of money will be paid to his or her legal heirs. There are 4 types of provident fund: statutory provident fund, recognized provident fund, unrecognized provident fund, and public provident fund. First of all, we just let you know statutory provident fund. SPP is set up under the provision of Provident Fund Act 1925. This fund was mainly started to promote saving habit among the government employees. This type of fund is maintained by the government and semi-government organization, local authorities, railways, universities, insurance company, and recognized educational institution. Then, second one, recognized provident fund. It is a fund which is recognized by the Commissioner of Income Tax. This type of fund is maintained by business house, industrial undertaking, and banks. Under this fund, both employee and employer will contribute. Employer contribution qualifies for deduction under section 80C. Employee's contribution for 12% of mentioned salary is taxable. Interest is exempted up to 9.5%. Then third one, unrecognized provident fund. It is a fund which is not recognized by the Commissioner of Income Tax Under this fund, both employee and employer will contribute. For employee contribution, there is no deduction under section 80C. Interest on employee contribution will be taxed as other source of income. Contribution of the employer and interest on such contribution will be taxed as salary income. Public Provident Fund. The above mentioned three funds, namely SPF, RPF and URPF, are for salaried people. In order to promote savings habit among those employees who are not salaried, PPF fund was started. This is mainly for self-employed people such as doctors, lawyers, accountants, pensions, etc. Even a person who is a member of any other provident fund can open an account under this type of fund to have his own savings. The total contribution can withdraw after a period of 15 years. Contribution can be between 500 and 1,50,000 per year. Contribution towards this fund qualify for deduction under section 80C, interest at the rate of 8.7% compound interest. Now we will see the tax treatment of provident fund. Under the tax treatment of provident fund, first we will have the employer contribution. Under statutory provident fund, we have the deduction under section 80C in full. Under recognized provident fund, deduction under section 80C in full. Unrecognized provident fund, deduction under section 80C is not given. Then public provident fund, deduction under section 80C in full. Then employer's contribution, full amount not taxable, fully exempted under statutory provident fund. Under recognized provident fund, employer contribution over 12% of employee salary is taxable. Under unrecognized provident fund, it is not taxable. Under public provident fund, there will be no contribution. Then interest, under statutory provident fund, it is fully exempted. Under recognized provident fund, interest over 9.5% is taxable. Rule 6 subsection B of Part A, 4 schedule, notified rate. Then unrecognized provident fund, it is not taxable. Under public provident fund, it is not taxable. Then lump sum amount received on retirement. Under SPF, it is not taxable. Under RPF, exempted in some cases. URPF, employee contribution is not taxable. Interest on employee's contribution, other sources, employer contribution and interest on it taxable as salary. Under PPF, it is not taxable. Next, we will see the tax reduction under section 80C. Section 80C of the Income Tax Act provide provision for tax reduction on a number of payment with both individuals and in the individual families. Eligible for these deductions, eligible taxpayers can claim deduction to the tune of rupees 1.5 lakh per year under section 80C, with this amount being a combination of deduction available under section 80C, 80CCC and 80CCD. Some of the popular investments which are eligible for this tax deduction are mentioned below. Payment made towards life insurance policy for self, spouse or children. Payment made to a superannuation or provident fund. Tuition fees paid to educate a maximum of 2 children. Payment made towards construction or purchase of a residential property. Payment issued towards a fixed deposit with a minimum tenure of 5 years. This section provides for a number of additional deductions like investment in mutual funds, senior citizen savings schemes, purchase of NABARD bond, etc. Then we will see the subsection under section 80C. Section 80C has an exhaustive list of deduction and individual is eligible for which have led to the creation of suitable subsection to provide clarity to taxpayers. Section 80CCC of the Income Tax Act provides scope for tax reduction on investment in pension funds. These pension funds could be from any insurer and a maximum deduction of 1.5 lakh can be claimed under it. This deduction can be claimed only by individual taxpayers. Section 80CCD aim to encourage the habit of savings among individuals, providing them an incentive for investing in pension schemes which are notified by the central government. Contribution made by individual and his or employer both are eligible for tax reduction subject to the deduction being less than 10% of the salary of the person. Only individual taxpayers are eligible for this deduction. Section 80CCF open to both HUF and individuals. Section 80CCF contains provision for tax deduction on subscription of long-term infrastructure bonds which have been notified by the government. One can claim a maximum reduction of rupees 20,000 under this section. Section 80CCG of the income tax permit a maximum reduction of rupees 25,000 per year with the specified individual resident eligible for this deduction. Investment in equity savings schemes notified by the government are permitted for deduction subject to the limit being 50% of the amount invested. Then tax reduction under section 80D. Section 80D of the income tax permit deduction on amount spent by an individual towards the premium of health insurance policy. This includes payment made on behalf of your spouse, children, parent or self to a central government health plan. An amount of rupees 15,000 can be claimed as deduction when paid towards the insurance for spouse, dependent children or self, while this amount is rupees 30,000 if the person is over the age of 60 years. On February 2018, Finance Minister Arun Jaitley presented the Union Budget to 2018 with a few changes in the tax deduction applicable for senior citizens. Under Section 80D, income tax deduction limit for senior citizens have been increased to rupees 50,000 for medical expenditure. Both individual and HUF are eligible for this deduction, subject to the payment being made in mode other than cash. Then, subsection under Section 80D. 80D is further subdivided into two subsections, offering clarity on the benefit available to taxpayers. Section 80DD provides provision for tax reduction in two cases, with the permitted deduction being 75,000 for normal disability and rupees 1.25 lakh if it is a severe disability. This reduction can be claimed in case of the following expenditure: on payment made toward the treatment of dependent with disability, amount paid as premium to purchase or maintain an insurance policy for such dependent. The permitted deduction is rupees 75,000 for normal disability and rupees 1.25 lakh for a severe disability. Both HUF and resident individuals are eligible for this deduction. The dependent in this case can either be a spouse, sibling, parents or children. Section 80DDB. Section 80DDB can utilize by HUF and resident individuals and provide provision for deduction on the expense incurred by an individual or family towards medical treatment of certain diseases. The permitted deduction is limited to rupees 40,000, which can be increased to rupees 60,000 if the treatment is for a senior citizen. This deduction under Section 80DDB for senior citizen and very senior citizen has been increased to rupees 1 lakh in the Union Budget 2018. Next we will see the tax reduction under Section 80E. Under Section 80E of the Income Tax Act has been designed to ensure that educating oneself does not become an additional tax burden. Under this provision, taxpayers are eligible for tax reduction on the interest repayment of a loan taken to pursue higher education. This loan can be availed either by the taxpayer himself, herself, or to sponsor the education of his heir, ward, or child. Only individuals are eligible for this deduction with the loans taken from approved charitable organization and financial institution permitted for tax benefit. Subsection of Section 80E. Section 18E. Only individual taxpayers are eligible for deductions under Section 80EE, with the interest repayment of a loan taken by them to buy a residential property qualifying for deduction. The maximum deduction permitted under this section is rupees 3 lakh. Then, tax reduction under Section 80G. Section 80G encourages taxpayers to donate the fund and charitable institution offering tax benefit on monetary donations. All assessees are eligible for this deduction subject to them providing proof of payment with the limit of deduction decided based on a few factors. 100% deduction without any limit. Donation to funds like National Defence Fund, Prime Minister Relief Fund, National Illness Assistance Fund, etc. qualify for 100% deduction on the amount donated. 100% deduction with qualifying limit. Donation to local authorities, association or institute to promote family planning and development of sports qualify for 100% deduction subject to certain qualifying limit. 50% deduction without qualifying limit. Donation to funds like PM Drought Relief Fund, Rajiv Gandhi Foundation, etc. are eligible for 50% deduction. 50% deduction with qualifying limit. Donation to religious organizations, local authorities for purpose apart from family planning and other charitable institutes are eligible for 50% deduction. Subject to certain qualifying limit, the qualifying limit refers to 10% of the gross total income of a taxpayer. Then, subsection of Section 80G. Under Section 80G has been further subdivided into 4 sections to simplify understanding. Section 80GG. Individual taxpayers who would not receive house rent allowance are eligible for this deduction on rent paid by them, subject to a max reduction equal to 25% of their total income or rupees 2,000 a month. The lower of this option can be claimed as deduction. Section 80GGA. Tax reduction under this section can be availed by all assessees subject to him not having any income through profit or gain from a business or profession. Donation by such members to enhance social or scientific or statistical research or towards the National Urban Poverty Eradication Fund are eligible for tax benefit. Section 80GGB. Tax reduction under this section can be availed by Indian companies only with amount donated by them to a political party or electoral trust qualifying for deduction. Section 80GGC. Under this section, funds donated or contributed by an assessee to a political party or electrical trust are eligible for deduction. Local authorities and artificial judicial person are not entitled to the tax reduction available under Section 80 GGC. Then tax reduction under Section 80I. Section 80IA provides an avenue for all tax-paying assessee to claim tax reduction on the profit generated through industrial activities. This industrial undertaking can be related to telecommunication, power generation, industrial park, SES, etc. The following subsections are related to 80IA. 80IAB. 80IAB can be used to buy SEE is developers who can claim tax reduction on their profit through development of special economic zone. This SEEC need to be notified after 1/4/2005 in order for them to be eligible for tax reduction. 80IB. Provisions of Section 80IB can be used by all assessee who have profit from hotels, ships, multiple theatres, cold storage plant, housing project, scientific research and development, convention centers, etc. Section 80IC. Section 80IC can be used by all assessee who have profit from state categorized as special. These include Assam, Manipur, Meghalaya, Himachal Pradesh, Uttarakhand, Arunachal Pradesh, Mizoram, Tripura and Nagaland. Section 80ID. All assessee who have profit or gain from hotels and convention centers are eligible for deduction under this section, subject to their establishment being located in certain specified areas. Section 80IE. All assessee who have undertaken in Northeast India are eligible for deduction under this section, subject to certain conditions. Tax reduction under Section 80J. Section 80J of the income tax was amended to include two subsections 80JJA and 80JJAA. First one, Section 80JJA. It relates to deduction permitted on profit and gain from assessees who are in the business of processing, treating and collecting biodegradable waste to produce biological products like biofertilizer, biopesticides, biogas, etc. All assessees who deal with this are eligible for deduction under this section. Such assessees can claim deduction equivalent to 100% of their profit for 5 successive assessment years since the time their business started. Then Section 80 JJAA. Deduction under this section can be claimed by Indian companies which have profit from the manufacture of goods in factories. Deduction equivalent to 30% of the salary of new full-time employees for a period of 3 assessment years can be claimed. A chartered accountant should audit the account of such company and submit a report showing the returns. Employees who are taken on a contract basis for a period of less than 300 days in the preceding year or those who work in managerial or administrative posts do not qualify for deduction. Then tax reduction under Section 80LLA. Deduction under Section 80LA can be availed by scheduled bank which have offshore banking units in special economic zone, entities of International Financial Service Center and banks which have been established outside India in accordance to the law of foreign nation. These assessees are eligible for deduction equivalent to 100% of the income for the first 5 years and 50% of income generated through such transaction for the next 5 years subject to the rules of the land. Such entities should be a relevant permission either under the SEBI Act, Banking Regulation Act or registration under any other relevant law. Next we will see the tax reduction under Section 80P. Section 80P caters to cooperative societies offering tax reduction on their income subject to certain conditions. 100% deduction is permitted to cooperative society which have income through cottage industries, fishing, banking, sale of agricultural harvests grown by members and milk supplied by members to milk cooperative societies. Cooperative societies which are involved in other forms of business are eligible for deduction ranging between rupees 50,000 and rupees 1 lakh depending on the type of work they are involved in. Deduction which can be claimed by all cooperative societies are listed below. First one, income which a cooperative society makes by renting out warehouses, income derived through interest on money lent to other societies, income earned through interest from securities or properties. Next, tax reduction under Section 80 QQB. Section 80 QQB permit tax reduction on royalties earned from sale of books. Only resident Indian authors are eligible to claim deduction under this section, with the maximum limit set at rupees 3 lakh. Royalty on literacy, artistic and scientific books are tax deductible, whereas royalties from textbook, journals, diaries, etc. do not qualify for tax benefit. In case of an author getting royalties from abroad, the said amount should be brought into the country within a specified time period in order to avail tax benefit. Tax reduction under Section 80 RRB. Section 80 RRB offers tax incentives to patent holders, providing tax relief to resident individuals who receive an income by means of royalty on their patent. Royalty to the tune of Rs 3 lakh can be claimed as reduction subject to the patent being registered after 31/3/2003. Individuals who receive a royalty from foreign shows need to bring said amount to the country within a specific time period in order to be eligible for tax reduction on such royalty. Then, tax reduction under Section 80 TTA. Tax reduction under Section 80A can be claimed by HEO and individual taxpayers. This section permits reduction to the tune of Rs 10,000 every year on the interest earned on money invested in bank savings account in the country. Then tax reduction under Section 80U. Tax reduction under Section 80U can be claimed only by resident individual taxpayers who have disabilities. Individuals who have been certified by relevant medical authorities to be a person with disability can claim a maximum reduction of Rs 75,000 per year. Individuals who have severe disabilities are entitled to a maximum reduction of Rs 1.25 lakh subject to them meeting certain criteria. Some of the disabilities which classify for tax benefit are autism, mental retardation, cerebral palsy, etc.